Sam&Cents, money that finally makes sense. On the 19th of August 2026, the United States Treasury announced that it would raise the maximum size of some of its long-end bond buyback operations from $2 billion to at least $4 billion, beginning on the 9th of September and running to early November. Long-dated Treasury yields fell that day, and much of that move reversed the next one. The same day, Bloomberg reported that Bitcoin rose almost 8%, and that CoinGlass data showed more than $1 billion of Bitcoin short positions liquidated in about an hour. No evidence I have seen establishes that the bond announcement caused the crypto move. There was a White House meeting with crypto executives the same day, and coverage at the time pointed at that too. And one thing before we leave those liquidation numbers. The biggest figure that traveled, about $2.75 billion, was the whole crypto market, not Bitcoin. Finance feeds corrected that on the 21st, and on the same tracker it reads about $1.2 billion over an hour. A liquidation number without its window is not a number, but one narrow feature of the day is worth stopping on. A great many people who had bet a price would fall were closed out before their argument could be settled. Which leaves the one thing that day cannot tell you, was that the machinery working or just whoever holds the other end of your promise, deciding faster than you can argue. You cannot run the 19th of August again without it, but somebody already did. 400 years ago in Amsterdam, a merchant named Isaac Lemaire began selling shares he did not hold. What held him to that promise was a notary, a court, and his own name. Nothing closed the trade automatically. The people on the other side went to the government, and the government wrote a rule. We have the rule, and 4 centuries of what happened next. It is usually told like this: a man who bet a company would fail, and the law they wrote to stop him. And it is, in almost every part, slightly wrong. He did not bet the company would fail, the company did not fail, and the law was not about him, it was about a practice. Now the warning label up front, because this is a subject people fight about and I am not going to help them. This episode takes no position on whether selling short is good or bad. Not once. I am not going to tell you it is parasitic, and I am not going to tell you it is healthy. And I am not telling you where any price is going. Nobody here is forecasting anything. Those are arguments about people. This is an episode about a mechanism, about what has to exist before a promise to deliver something later is a promise anybody can collect. When I describe how this works today, I am describing United States rules. Other countries differ. And I will not quote you a live market number, those go stale, and a stale number is just a wrong one. This is general education, not personalized advice, and nothing in it is a reason to buy or sell anything. So, selling short, here is the machine underneath. Ordinarily you buy a thing, you hold it, and you hope it becomes worth more. Selling short reverses the order of operations. You sell first, you deliver later, and in between you have to get hold of the thing you have already sold. Your gain, if there is one, is the gap between the price you were promised and the price you eventually pay. And when you buy something, the worst that can happen is it goes to zero. There is a floor underneath you. When you have sold something you do not have, there is no ceiling above you. The price can keep rising, and what you owe rises with it. Which means the whole trade rests on one question. Somebody has to be able to make you keep that promise. Hold that against the 19th of August. Somebody who has sold what they do not own must buy it back. Put many of those promises in one place, each backed by collateral. Watch a rising price. Those who owe fall short. The venue closes the position for them, and closing a short means buying. Where that buying reaches the market, it moves the price the same way again, and closes the next group too. That is a liquidation cascade. Whether it started that day's move or only amplified it, I cannot tell you. What it explains is the clock. To see why keeping that promise was so hard in 1610, look at what had just been invented. In 1602, the Dutch East India Company was chartered, and its charter let a registered interest in the company be transferred to somebody else, and written into the company's own books under a new name. Not a partnership you wound up at the end of a voyage, a line in a ledger that could change hands, and a market grew up around it gradually, not from day one. Isaac Lemaire was there from the start. He was one of the largest subscribers in the Amsterdam chamber, and he became one of its directors. And then, in 1605, he stopped being one. There was a dispute about his handling of company business, accusations were made, and he signed a settlement. And let me be precise, because the popular version is not. He was not convicted of anything. No trial, no verdict. What he walked out with was years of knowing exactly how that company worked from the inside, and no way left to act on it from within. 4 years later, he acted on it from outside. Early in 1609, Le Maire and a group of fellow merchants formed a consortium to trade the company's shares together. Its founding document does not survive, so I'm not going to give you a precise date or a head count. Historians reconstruct both and do not agree. They bought and they sold forward, promising delivery months, and sometimes 2 or 3 years into the future, sometimes for more shares than they actually held. As far as the surviving archive shows, that is the earliest organized group anywhere doing this to the shares of a company, which is not the same as inventing it. Merchants had sold commodities they did not yet have for centuries. So why bet a company's shares down in 1609? Because that spring, on the 9th of April at Antwerp, the Dutch Republic and Spain signed a truce. 12 years of it. And peace was not obviously good news for a company whose fortunes had a great deal to do with war. Le Maire and the merchants around him argued that the company's finances and its unsold stock justified a lower price than the market was paying. The directors disputed every word of it. But be careful, nobody can tell you the truce made the price fall. There is no continuous record of what the price was. What 1609 establishes is durable. The cause everybody names can be right or wrong, and the record will not tell you which. And the same argument is running about the 19th of August. Most of the day's coverage put the move on the Treasury announcement. The skeptics put it on positioning, a crowded short book, thin August liquidity. Others say it was a stack, that notice, a securities regulator proposal the day before, a White House meeting the same afternoon. Nobody has measured how much was which, and I will not pretend otherwise. Back in 1610, the directors' answer was not to outtrade him. They went to the state and petitioned. Their argument is not a stupid one, and it has never gone away. They said the practice hurt people who had done nothing except own the shares. Widows and orphans, the petition said, meaning ordinary holders who could not tell a coordinated campaign from an honest repricing, and who would be left holding the thing at the end of it. And to be fair, in the other direction, these were not innocents who did not understand markets. Directors traded forward themselves. It was one group of very experienced traders asking the state to stop another. On the 27th of February 1610, the States General of the Dutch Republic issued a placard. It prohibited selling shares you did not own, and it required that transfers actually be registered. As far as anyone has found, it is the first time a government anywhere wrote down a rule about selling short. Be careful, because that is easy to inflate. It is not the first financial regulation of any kind. Laws about lending at interest and about bills of exchange are much older, and Amsterdam already had an ordinance governing its own exchange. But about this trade, this is where the written record begins. What happened next is why this episode exists. Now here is what that placard did not do. It did not put anybody in prison. There was no regulator, no investigation, no penalty for having made the trade. It is not true that 1610 had no way of enforcing anything. It had a great deal. Transfers went into the company's own books. Brokers and notaries wrote bargains down. There were courts, and people used them. There was set off, where what you owed was netted against what you were owed, and everybody knew who you were. What the placard changed was subtler than a ban, and much stranger. By making a certain kind of bargain prohibited, it made that bargain doubtful in front of a judge, which meant that whoever was losing on one could point at the ban and refuse to settle. Now hold that against the venues where most of the 19th of August traded. There the same problem is settled before any court. When the collateral behind a position runs out, the machinery closes it, not as a penalty, not as a judgment about you. 1610 banned the bargain. We automated the margin call. That placard handed people an excuse, and it was available by definition to whoever was losing. A rule against a bet that voids the bet is not a rule the winner can use. Roughly 70 years later, an Amsterdam broker, Joseph de la Vega, described exactly this. Traders invoking the edicts to escape contracts they had lost on. The market did not find them. It stopped dealing with them. And be careful, that is the 1680s, not 1610. What the record shows across those decades is not a market that stopped selling short. It is a market that kept doing it, while the state kept saying not to. The rule did not stay written once. The Dutch reissued it, again in the 1620s, again in the 1630s, and again in the 1670s. Be careful about what that proves. It does not measure whether anybody obeyed, only that the authorities kept believing the practice was still going on. In 1734, London passed its own version, Sir John Barnard's Act, which voided time bargains in company stock where the seller did not own the stock. It stayed on the books until 1860. In September 1931, as Britain left the gold standard, the New York Exchange's own governing committee, 3 years before any federal securities regulator existed, banned short selling on its floor for 2 trading days. A separate, narrower rule about the price at which you could short followed that October. In September 2008, the American Securities and Exchange Commission issued an emergency order covering 799 financial stocks. It was extended, then it ended in October. In March 2020, regulators in France, Italy, Spain, Belgium, Austria, and Greece did the same kind of thing, and those measures were renewed and then lifted. These are not the same law, different countries, centuries, instruments, and reasons. What they have in common is not a statute. It is a moment. The price is falling, somebody is selling what they do not own, and the thing somebody reaches for is a rule. And on the 19th of August, 2026, nobody reached for it. The positions closed anyway on thresholds those traders had already agreed to, written by a venue, overseen by a regulator. The moment still arrives. The rule is already written. So if the rule kept being written, what actually changed? Machinery, not prohibition, plumbing. In the United States today, before most short sales, your broker has to have reasonable grounds to believe the shares can be borrowed. That is called the locate. The shares generally do then get borrowed, and borrowing is not free. There is a stock loan charge, quoted as an annual rate, and it climbs when the shares are hard to find. Your position gets revalued, and if it moves against you, you are asked for more collateral, and if you cannot produce it, your broker may close the position without asking your permission. And standing between the two sides of the trade, there is now a clearinghouse whose whole purpose is that neither of you has to trust the other one. None of that existed in 1610. Every bargain there was a private promise between two named parties. And here is where the comparison stops. All that machinery reduces the risk that a promise goes uncollected. It does not eliminate it. Deliveries still fail. A position can be closed without your consent, but when depends on collateral rules, on whether the lender wants the shares back, on settlement. Nobody gets closed out overnight because somebody felt like it. That machinery decides when you get closed out. It does not decide whether the price comes back. So what happened to Isaac Lemaire? The trade did not work. The price recovered. And when it recovered, the consortium was on the wrong side of it, owing shares that now cost more than they had sold them for. Members of it failed. The earliest organized bet against a company's shares that we can still read about ended in the thing traders today have a word for. They got squeezed. So, what does 1610 tell you about the 19th of August? Not what to do. Compare them on one axis, what the authority in the room was actually doing, and the comparison does not survive contact. In 1610, the state wrote a rule aimed at the trade itself, at selling shares you did not own. In 2026, the Treasury was managing its own debt. It changed no rule about crypto, and no evidence says it was aimed at anybody's position. These are not the same event, and anybody who tells you history repeated itself that day is selling you something. What they share is one narrow thing. A position you have to close later can be closed for you, on terms set by somebody who is not in your trade, a lender, an exchange, a clearinghouse, or a government. That is not a prediction. It is plumbing. Isaac Lemaire died in 1624, so, your 2 minutes. When you hear that a stock is getting squeezed, that sentence is about 2 numbers you can go and look at. The first is short interest. How many shares have been sold by people who still owe them, measured against the shares available to trade? It is reported on a delay, and it is an imperfect count. The second is what it costs to borrow those shares, a rate your broker quotes, which differs between brokers and is not published in one place. Neither number tells you what a price will do. Neither is a reason to buy anything, and neither is a reason to sell anything. They tell you how crowded the other side of that trade is, and what the people on it are paying to stay there. Next time, 1956, and a government that found out its own position could be closed for it, on terms set by somebody holding its currency. Same channel. So there it is, small boring moves that quietly win. If your money makes a little more sense now, hit subscribe to Sam&Cents. And the next one's right here. It picks up right where this leaves off. See you there.